Did somebody just light a match in the middle of the world's biggest monetary gasoline fight?
What? Maybe, but who cares?
This is Rafi of the Endgame Investor, and today we're going to talk about the explosion in rates from 2-year maturities all the way to 30-year in U.S. Treasuries and around the world, and how certain bond investors like Xi Jinping of China are getting a little bit nervous, and how this could be the match that sets off a hyperinflationary explosion.
Know what could really help you sort through these important issues?
What? Orange Mocha Frappuccino!
Wake me up before you burn, shine brighter than Doris. When you act so cool, come on, wake me up before you.
If there's anything that this horrible tragedy can teach us, just because we have chiseled abs and stunning features, it doesn't mean that we too can't not die in a freak gasoline fight accident.
By the way, this means I'm exempt. You could probably guess from what. Monday was a day off in the bond and stock markets in the United States on Wall Street, but this morning, bond yields rocketed higher from the notes category from 2-year maturities all the way to the bond category of 30 years. We'll start with the 2-year Treasury, and we'll show you how yields seem to have broken technical barriers at the 200-week moving averages, beginning with the 2-year Treasury right here. Here we see overnight yields popped up on the 2-year Treasury, 0.07 points, meaning 7 basis points. That is a huge jump. And if we look at where the 2-year is technically, this is our next chart here, the 200-week moving average, which has not been challenged at all since the end of the world as we know it back in 2020. It is at 1.23, so we haven't quite broken through on the 200-week moving average there. However, let's look at the 3-year. 3-year up 8 basis points this morning to 1.344. Where are we on the 3-year? Next chart. Aha, the 200-week moving average is at 1.31, so we have broken through on the 200-week moving average on the 3-year Treasury to 1.34, which means that it's going to be harder to raise money from 3-year Treasuries going forward, and they are going to have to sell more in order to raise the same amount of money. Let's go up to the 5-year. 5-year up 8.5 basis points, 0.085 points, up to 1.631. Where are we on the 5-year? The 200-week moving average is at 1.46. We have broken through it. We haven't even bounced below it. Usually when these lines are challenged for the first time in many, many months or even years, you will have a resistance zone and you won't immediately break through it. But this time on the weekly charts, the line has been immediately broken through. Moving up to 7 years, it gets worse. This 7-year Treasury is up 7.2 basis points. Where are we on the 7-year? Here we are. We've already broken through that 2 weeks ago at 1.65%. 7-year Treasury broken through the last technical barrier. Here's the 10-year. This is what most use as a benchmark to rates all over the world. 10-year up 6 basis points to 1.831%. The 200-week moving average is at 1.79. We've broken through it without so much as a bounce, even a small bounce, as resistance should have been established here, but it wasn't. We've broken through. Moving up to 20 years. This is the bonds category now. Up 4.3 basis points, 2.218%. Here, we've also broken through the 200-week moving average, which is at 2.14%. So 20-year broken resistance. 30-year, 2.15%, up 3.5 basis points this morning. 30-year, still have a little bit to go before the 200-week moving average is challenged at 2.28, but we will get there. All of these yields, every single one of them, all across the yield curve, are in negative real territory. That means anyone who buys any one of these securities is guaranteed to lose money through inflation. So why do they keep buying? And the only answer is because they knew the Fed would buy them from them for higher prices and even more negative rates because the Fed doesn't care about making money, it prints money. But now that there is no assurance that central banks will buy this negative yielding paper anymore, there is no fundamental reason for negative real interest rates to suddenly shoot back up really quickly to positive real interest rates where actual interest is earned on paper. Imagine that. Amazing. And a quick slingshot back into positive real territory would require hikes from the free market of about 600 basis points. Minimum. Is that going to happen?
What? Maybe, but who cares?
And if it does, that's the end of the system. Look who's worried about this and raising warnings. China warns West against rapid interest rate rise. I wonder why. Could it be because he has serious misgivings for the global economy and he wants to be a good leader and warn major economies against the dangers of rising interest rates? No. Here is the subtitle. Xi Jinping says major economies need to be wary of negative spillovers hitting global recovery. Oh yeah, I'm sure he's just a macroeconomist looking out for everyone's best interests. China has warned, says The Guardian, that US and Europe against a rapid rise in interest rates that would slam on the brakes of the global recovery from the pandemic. Well, I don't think we need to read any more of that because I will show you why Xi Jinping is so worried, so graciously worried about rising interest rates. And it's not because he's worried about the global economy, he's worried about his own wallet. This is the tick figures, how much treasuries are owned by foreign countries. Look who's number 2 at 1065.4 in this little square right here that I'm highlighting. That means $1.065 trillion in US treasuries, almost all of them notes and bonds, of which interest rates are rising, which means the prices of those securities are going way down. If those treasuries held by China fall in price too fast, they will lose a lot of money and a lot of backing to their own currency, and their own currency will spiral down as well. What Xi is actually worried about is his own bond portfolio disintegrating to worthlessness. Will it happen immediately? No, but it could happen fast now that serious technical barriers have been broken, and there is no way that the Fed can restart quantitative easing or whatever the hell they want to call it without making global markets understand that the dollar is finally toast. Have we begun the final spiral into a high interest rate, high inflation chasing abyss? Have we lit the match at the proverbial gasoline fight in the gas station that are the world's global central banks? It very well could be. We'll see what happens this week and next week and the week after with interest rates and who can come and save them. With price inflation raging the way it is, it's not immediately going to be central banks, but there will be a point where they come back into the monetary system and cause the final explosion that will be the end of the global fiat monetary system that we have known since 1971. We're close now. This is Rafi, the Endgame Investor, and before the final match is lit, if it already is lit and the chain reaction has already begun, you may want to follow me and see what I'm doing to prepare for this and preparing my subscribers. You can also sign up to be my patron at Patreon to get my biblical commentary on liberty and economics week by week following the Jewish Torah reading cycle. Thanks, guys, and I will see you sometime this week when some other match is lit. I'm sure it will be soon. Goodbye.